Boyer. I'm a manager in Eide Bailey's international tax practice. I'm located in Minneapolis, and I've had, I suppose you could call it the pleasure of following GILTI over the last year and a half, and the various changes and, of course, the very challenging times of trying to assist taxpayers be compliant with GILTI while the rules are being written. And so it's made for an international tax, I guess, as exciting as tax can get. It's made it pretty exciting. In addition, I'm being joined by Chris Stroh, who's been gracious enough to join us and assist with manning the chat box for questions that come in. Chris, I'll just hand it over to you to introduce yourself.
Thanks, Aaron. Like Aaron said, I work with Aaron in the International Tax Group here at Eide Bailey. I am also a tax manager. I'm here in a support role for Aaron today. So if there's any questions that pop up, please, as we've mentioned a few times here, and sincerely encourage using that chat box for question box for a Q&A, and we can help get some answers in a timely manner, and we'll go from there. Thanks, Aaron.
Sure, sounds good. Well. Really looking forward to this presentation. I think if you're thinking about what some of the takeaways are for today, I think really what is GILTI? We'll cover that, why it applies or how it applies, what are some of the elements for GILTI. The presentation is not really designed to go all the way through GILTI in an hour and talk about some of the more refined elements of the GILTI calculation, but more to give a high-level overview. And then from there, we'll jump into some final and proposed regulations, how that affects GILTI and affects taxpayers, of course, who have been trying to model or implement GILTI. And then lastly, and perhaps most importantly, what we'd like to do is go through some modeling examples and just some considerations that taxpayers, specifically individuals, are thinking about when they're attempting to comply with GILTI. As individuals, we're hit fairly hard for GILTI, and to be honest, when the GILTI rules just came out, it was looking really grim for individuals. Almost like you had to change your structure in order to avoid paying a significantly more amount of tax. And now, as we've seen over the last year and a half, as guidance has come out, it's looking a little better for individuals, but still requires some thought and potential for some planning. I thought maybe we could start this presentation to go in and look at a key for corporations that are doing planning related to having income in a foreign corporation. And so currently for a USC corporation, one of the main planning ideas is that if you have income of a foreign corporation and that foreign corporation issues a dividend back to the US, that USC corporation can be eligible for 100% dividends received deduction. And that's, of course, very favorable. And that's different from the old rule. And I've skipped over a slide, which you can look at that for reference on kind of how the old rule worked. But for C corporations, now the opportunity just to pay tax in a foreign jurisdiction and then pick up income when they receive a dividend, but then be allowed 100% dividends received deduction is obviously quite favorable. And that eliminates issues with trying to credit foreign taxes that are paid in the foreign jurisdiction, going through that calculation, and maybe finding out at the end of the day that they're somewhat limited. The key with the dividends received deduction is really in that foreign entity, in that foreign corporation, that income needs to be eligible for deferral. And so I think of that kind of as two hoops the foreign corporation needs to get through. One hoop is subpart F, which we're going to talk about a little bit later on, and then the other is GILTI. And if the foreign corporation, if that income can make it through both those hoops, and if it's eligible to be deferred, meaning it's not deemed to come back to the US, then that's the type of income that's typically eligible for a dividends received deduction. But you have to get through those anti-deferral rules first. And in order to do so, especially now with GILTI, it requires some complex calculations and potentially some planning in order to ensure that you would be able to get to a point where your earnings are eligible for deferral. And I'm going to jump right into our first polling question, which is related to the deemed repatriation. And the question is, were you or your organization subject to Code Section 965? And that was an event that was fairly painful for a lot of taxpayers, mainly in 2017, but also in 2018, of having accumulated earnings in the foreign jurisdiction being deemed to be distributed back to the US, kind of as a precursor, so that now with this new dividends received deduction, those foreign corporations are starting with zero of accumulated E&P that hasn't been taxed in the US. Quite a few people were not subject to the 965 deem repatriation. So hopefully that meant your year in 2017 was a little better than maybe some of other taxpayers that had to go through that calculation, as it was quite complex. So let's talk about GILTI and just really the high level mechanics of how GILTI works and why it's important for US taxpayers. Really the big picture for GILTI is that it more or less starts in 2018. Technically, it starts with CFCs whose year ends begin after 12/31/2017. But GILTI for a lot of calendar year taxpayers will apply in 2018. It applies to US shareholders who have an interest, obviously, in a foreign corporation, especially when that foreign corporation has taxable income. So really what you're looking for is, do we have a foreign corporation? Does it have taxable income? And is my foreign corporation controlled by US shareholders? And if it is, then typically we have a situation where GILTI could apply. It works very much like Subpart F, and if you're not familiar with Subpart F is an existing anti-deferral rule, which basically said if you had a foreign corporation and it was earning profits in that foreign jurisdiction, then not all the income that that foreign entity was earning was eligible for deferral. So sometimes you had to deem distribute back those earnings, regardless of whether you really had a cash distribution to your US shareholders. And so GILTI works fairly similar to that. If we have GILTI, then that means that we have this deemed distribution coming back to the US, and our shareholders need to pick it up as income. For C corporations and for individuals, trusts, and estates that are making a 962 election, there's a potential for that income that's being deemed distributed back to the US under the GILTI regime to be eligible for a 50% deduction. So if you had $100,000 of GILTI income, automatically off the top, you might get a 50% deduction. So now you're down to $50,000 of income, which is quite favorable. And then of course, if there are any taxes that are being paid in the foreign jurisdiction, those are typically eligible to be claimed as a credit, at least for C corporations. And again, for individuals, trusts, and estates making a 962 election, those taxpayers would also be eligible to claim those foreign taxes as a credit in the US. And we'll talk through the 962 election later on towards the end of this presentation. For those of you that may not be familiar with it, it's a very powerful planning opportunity for individuals, and I would say not very painful because it's something they can do on a current year return. So I mentioned Subpart F, and that regime has existed for a while. So what does that look like? And I think of Subpart F really when you have a foreign corporation and it's earning income. Subpart F really looks at the type of income, not necessarily the amounts, but it looks at the type and says, do you have foreign income that's typically passive in nature, like interest, dividends, rents, royalties, annuities, commodities, currency, I think insurance as well. If you have income that's passive in nature, the US kind of sees that it's fairly easy just to move that to a foreign corporation rather than have it being earned by a US corporation. And so since it's easy to move, of course, taxpayers could manipulate when they were going to pay tax in the US. So the US says, well, that type of income, it's ineligible for deferral. So that means if you have Subpart F income, that's deemed to be distributed back to the US. There are other types of income, related party sales income, related party services income. Concept is the same. Basically, if it's a certain type of income, then under Subpart F, that's deemed to be a distribution back to the US. GILTI works very similar to that, in that if you have income that's subject to GILTI, that it's also being deemed to be distributed back to the US. But GILTI is more based on, I think of it as an amount, and throughout the next few slides, we'll see why it's important that you get to an amount to determine whether that income is actually going to be GILTI or not. But let's say you had a foreign corporation that had Subpart F income or GILTI income. Really, is it just any foreign corporation, or are there specific rules on when special thresholds that need to be met in order for that foreign corporation to be subject to these anti-deferral rules? And the answer is yes. You need to have a few things. One, you have to have something called a controlled foreign corporation. So that foreign corporation needs to be owned greater than 50% by taxpayers that are considered US shareholders. And US shareholders in this case is a defined term. A US shareholder isn't just a US person that owns stock, it's a US taxpayer that owns 10% or more of the foreign corporation. And so if you have US taxpayers who own 10% or more of a foreign corporation, and when you add all those up, when you add up all those 10% shareholders, do they own more than 50% of the foreign corporation? Then you have a controlled foreign corporation. And in that case, that foreign corporation is subject to these anti-deferral rules. And in addition, the US shareholders are the ones that are subject to potentially bringing in income or including income on their US tax return. And so a couple fairly important thresholds before you even get to, well, do I have GILTI? The questions usually are, well, do I have a CFC? And then is the US person that I'm assisting with, or if I'm the shareholder, do I have a 10% or more ownership interest? And you would look at not only direct ownership, but also indirect and constructive ownership. Lastly, the US shareholder needs to own the stock at the end of the year, on the last day of the year. So what can happen is you could have a US shareholder who owns the stock for a majority of the year, 90%, 95%, of the year, and then sells it to another US person. That US person that purchases it usually is on the hook for all of the GILTI or all the subpart F income during the year. So that's something to keep in mind if you're involved in a sale transaction or a purchase of a CFC, making sure that it's addressed. Well, if I have to pay tax on all this GILTI, even though it was earned, maybe none of it was really earned while I was a shareholder because I only owned the stock for a couple of days before the year ended, might want to have that in the contract so there's additional compensation for it. So with GILTI, I've mentioned we have this deemed repatriation, or I should say this deemed distribution back to the US, very similar to subpart F income. Really, there's a couple thresholds within GILTI. So we talked about thresholds just to get to a CFC and a US shareholder. Those are the ones that really are subject to these GILTI rules. But if you think about GILTI more as an amount rather than a type, then what we're typically looking at is we have a foreign corporation and we look at its income and we say, okay, does that income exceed a certain threshold? And in this case, that threshold is 10% of the CFC's tangible depreciable assets used in a trade or business. And so we look at those assets, we multiply it times 10%, we kind of say that's our floor. Did the CFC earn income in excess of that floor? And if the answer is yes, and we don't have to worry about subpart F income, we're just looking at GILTI, then typically income that's in excess of that floor is deemed to be a distribution back to the US and therefore subject to US taxation. C Corps, as I mentioned, they get a favorable 50% deduction on that income. So if we do have GILTI to pick up, a C Corp would be able to cut that in half by 50%. That does change later on in 2024 down to 37.5%. And as I mentioned, and I'll continue to mention, that 50% deduction is eligible for individuals, trusts and estates that are making the 962 election. So once you have a taxpayer that's included GILTI income on their return, or they've determined, okay, I have an amount that's subject to tax on my US tax return, the question is, well, do you get any benefit of foreign taxes that were paid in the foreign jurisdiction? And the answer is, for a C corporation, yes. Typically you would. You have to haircut it by 20%. So if you have $100,000 of foreign taxes that are attributable to that GILTI income, then typically you're only eligible to claim 80% of those, or 80,000 in that case. Taxes that you are going to be claiming, 100% of those need to be included in income, and that's covered under the 78 gross up. But if you're thinking big picture at a C corporation, okay, so I've got my GILTI income, how much tax do I need to theoretically pay in the foreign jurisdiction so I don't end up with the US tax liability? And the answer is it's about 13.125%. And that doesn't consider expense allocations, which is part of a foreign tax credit calculation. But really what that says is if you paid 32 or 13.125 of tax in the foreign jurisdiction, you multiply that times 80%, you get to 10.5%. And that's really the tax for a corporation that's applying to GILTI income. Let's look at a numerical example just to kind of put that all in perspective, so in this case, we have tested income of $1,000, and we have our QBI, our qualified business asset investment, of 6,000. We multiply that 6,000, that gets us to our floor of 600. And then because our income is greater than our threshold by 400, we have $400 of GILTI income. And for C corporations and for individuals making a 962 election, we'd then have a $200 deduction. And so we'd be left with $200 of income that's subject to corporate tax in this case. And that would get us to $42. And at the end of the day, if you take 42 and you look at, well, I had $400 of income, but I only paid tax of $42, that gets you to an effective tax rate of 10.5%, which if you're thinking, well, I thought GILTI was designed to push corporations to have more U.S. to keep operations in U.S. rather than to push them to have operations in a foreign jurisdiction. This does look a little bit strange in that if they generated domestic income, they wouldn't get the 50% deduction. If they were just operating from the U.S. and had regular income, that would be subject to the full 21%. But because they have it go through GILTI, through a foreign corporation, it comes back as GILTI, there's a favorable 50% deduction, and that's reducing the corporate tax rate down to 10.5%. Let's look at, just real quickly, a couple of the elements of GILTI. So we've talked high level how GILTI works and that we have this deemed distribution if we're over a certain threshold. What types of income would be subject to GILTI? And the answer is not all of it. Again, going back to my example of hoops, typically you look at subpart F and you say, do I have subpart F income first? And if you do, then that's subject to subpart F regime, typically not GILTI regime. But if you get through subpart F, if you get through unscathed, then you have to consider GILTI. And GILTI would typically pick up all the income except for a certain income that's excluded. There's a list here that shows which types of income are excluded from the GILTI calculation. One item that I don't have bulleted here that we'll talk about when we get to the proposed regulations is that in the future, income that is considered a high tax, GILTI income that is considered high taxed in the foreign jurisdiction would also be added to this list and excluded. But for now, that's a proposed rule, of course, subject to change, and it's not quite final yet. One thing to keep in mind that, foreign corporations usually keep their books according to foreign accounting rules, and they file tax returns according to foreign tax rules. And in the past, for subpart F, we really just kind of worried about E&P. We didn't worry about taking that income of the foreign corporation and converting it to taxable income like we would for a domestic C Corp here in the US. But for GILTI, now once we've identified our GILTI income or our tested income that's subject to GILTI, then we have to convert it from those book numbers to taxable income using the same tax principles that apply to US C corporations. So that means that we're going to be doing M1 adjustments. We're going to be looking at 163J and whether there's interest limitations. We're also going to be looking at accounting methods, and that can take quite a bit of additional work, especially if there's a few C Corps, or I should say CFCs in the structure, because before we could kind of just report information on our US tax return, and if we had no subpart F, that was kind of the end of the calculation. But now with GILTI, we need to really refine that taxable income and say, or that income and say, do we have taxable income? Because if we do, and if it's going to be over that threshold, then that means we need to be picking it up as taxable income on our US tax return. One thing that's a fairly important concept with GILTI is that if you have a US shareholder, and recall that's a 10% shareholder in a foreign corporation. So if you have a US shareholder and they have interests in various CFCs, they typically will aggregate all the elements or the characteristics of each CFC's GILTI items on their personal tax return, and then determine overall, on an aggregate level, do they have net GILTI income or not? And for instance, if you had a CFC1 that had positive tested income, and you had CFC2 that had negative tested income, then a US shareholder would be allowed to offset some of the tested income from CFC1 with losses of CFC2. So that aggregation all happens on a form on a US individual tax return. So I mentioned that 10% floor, that really looks at tangible depreciable assets of the CFC. So if you're looking at the balance sheet of the CFC and you say, okay, how do I determine my floor? You would look at, well, what's tangible depreciable property? And it'd be nice if we could just use book numbers and multiply that times 10% and say, well, that's whatever's on my balance sheet at the end of the year times 10%. That gets me to my floor, but of course it's not that easy. With GILTI, we're required to convert those book numbers or that depreciation schedule to ADS, or using ADS lives, which are typically a little longer than maybe book and definitely longer than tax, and then use straight line depreciation and determine quarterly what the value of those assets is, or the tax basis of those assets is at each quarter. And then you average it, and that gets you to an amount to multiply times 10% and arrive at our floor. That floor can also be reduced by interest expense of the foreign corporation. So if you go through all those mechanics and you end up with $100,000, let's say, of a floor, but the foreign corporation's deducting $200,000 of interest expense, that $200,000 is going to completely eliminate our floor, and so we'll have zero as our floor. So interest expense plays a really key role in determining how much GILTI is coming back to the U.S. One other item I want to mention on this slide is foreign tax credits. That's a very important part of the GILTI regime, and being able to claim foreign taxes that were paid in the foreign jurisdiction by the CFC as a credit in the U.S. is one of the most important pieces of GILTI, and avoiding GILTI or mitigating GILTI. And so typically a C corporation is eligible to do that. Picking up GILTI, then it's typically eligible to claim foreign taxes as a credit against its U.S. tax liability attributable to that GILTI income. One thing that I want to mention with crediting foreign taxes against GILTI income is, in the past we had just kind of a couple baskets for foreign tax credit purposes, and the design or the reason for those baskets is the IRS didn't want, if you had income in your general basket and you had taxes that were attributable to that general income, it didn't want you moving or using those credits in the general basket to offset U.S. tax that were attributable to, let's say, foreign passive income. So by categorizing or creating baskets, you had taxes that were kind of stuck in those baskets, and you couldn't use them to credit U.S. tax attributable to income that was in another basket. And GILTI created another basket. There's also another foreign branch basket that was created, but in this case, GILTI has its own basket, and it has its own rules related to that. So if you have your U.S. shareholder, you say, okay, I've picked up my income, my GILTI income, I have foreign taxes that are attributable to that income, I'm going to claim those as a credit. That income goes in a basket, and those taxes go in a basket, and those taxes that are attributable to GILTI, you can't use those to credit U.S. income tax attributable to income in other baskets. You're stuck just with the GILTI basket. The other thing with that GILTI basket is you don't credit or you don't carry back taxes that are in that basket, and you don't carry it forward either. And so you're really looking at it year by year and seeing, okay, am I able to use these taxes against my U.S. income associated with GILTI? And if the answer is no, then those just kind of go away. So what happens if we have GILTI? We've talked through kind of the mechanics at a very high level of the calculation, but what happens if we have GILTI? Well, a couple things happen. One, when we pick up GILTI, we typically create something called a previously taxed income account in the foreign corporation. So if you're familiar with U.S. flow-throughs like partnerships and S-corps, you're probably familiar with the concept of income is flowing through to the partner or the shareholder, even though they might not be receiving a cash distribution. And so when that income flows through to them, they get an increase in basis. And later on, when they receive a distribution from that partnership or S-corp, then that reduces their basis. But that distribution typically is not considered taxable income. Concept is fairly similar when just looking at the CFCs with GILTI, in that you have your foreign corporation, you have this deemed distribution, even though no cash has been distributed. So we create this PTI account, and we track how much income we've picked up on our US side. And then when there's a distribution, that typically reduces that PTI account. And there's an ordering rule that says if you have earnings in a foreign corporation and you have a PTI account, your distributions first come out of that PTI account. So because you've already paid tax on it, first you receive that cash. And then if you've exhausted that PTI account, then if there's earnings sitting in that foreign corporation, then that would be a distribution of E&P and would be considered a dividend. The other thing that GILTI does is if we pick up GILTI, that also increases our tax basis in the asset, in the stock. And so later on, if we sell the stock, then we would have less capital gain to recognize. And of course, distributions would reduce our basis. And with that, I think we'll go into our second polling question, which is, have you completed your 2018 Code Section 951A calculations? Yes, no, or not applicable?
Hey, Aaron, thanks for all that information. This is Chris. Just want to remind everybody, Aaron went over a lot of concepts pretty quickly there, and there's a bit of depth to some of these topics. If, again, just as a reminder, if you have any questions, feel free to shout them out on the question and answer tab, and we can hopefully get them addressed as we go along.
Yes, sounds good. Chris wants to stay busy. That's what it sounds like. Wow, so we have no completed 951A calculations. I would say that's fairly on par with a lot of clients who've been waiting for additional IRS guidance to come out before completing their calculations. And now that we have that, we have a little more certainty, although in some cases it hasn't been all that favorable. Let's jump into the final regulations and the proposed regulations, which came out less than a month ago and had some fairly significant implications for partnerships and also had implications for income that in a foreign jurisdiction is considered high taxed. And let's start at the top with the former proposed regulations. So recall that there's a couple things that we need to have GILTI applied to a US shareholder, right? We need to have a CFC. And in this case, we have US shareholders that own 10% or more owning more than 50% of this foreign corporation. And so that entity at the bottom is considered a CFC subject to these GILTI rules. The question is a partner considered a US shareholder for GILTI purposes? And remember that we have to get to that 10% threshold. And under the former proposed rules, they said, well, if you have a partnership that owns an interest in a CFC, and that partnership owns 10% or more, then that partnership is considered a US shareholder. And so the way the rule would work is, in this case, partner one, because it indirectly or constructively owns 10% or more of the CFC, would receive its allocable amount of CFC information. And then partner one, if it had other interests in other CFCs, would aggregate all of that income, all of that CFC information from this partnership with its other interests and arrive at a net GILTI income. Or perhaps they'd be able to use up losses and they would end up with no GILTI income. But partner two, under the proposed regulations, was kind of stuck because since partner two didn't own more than 10% indirectly or constructively, it didn't own 10% or more of the CFC, then in that case, the partnership just allocated it GILTI income and the partner was stuck and they just picked it up and they didn't aggregate it with other CFC interests that they may have had. That was fairly debatable. Treasury received a lot of comments. And under the final rules, the IRS did a 180 and they said, okay, we agree that that doesn't make a lot of sense. And so now you look at the partnership for some considerations of GILTI and subpart F, but when you're determining who is going to include or who needs to include their share of GILTI income, you actually look at the partners and determine whether they, independent of the partnership, do they have an indirect, direct, or constructive ownership of 10% or more in the CFC. And you can see in this case, partner two only has an 8% interest. And so they would not be considered a US shareholder and thus not subject to GILTI income. Note that there's still constructive ownership rules that need to be considered, and if partner one is related to partner two, then partner two would be over that 10% threshold and thus subject to the GILTI rules. I have another slide. This illustrates the constructive ownership rule from the regulations, and I'm throwing this on there just to highlight the importance of the constructive ownership rules. And there's a rule out there that says if a US entity, or I should just say, if you have an entity that owns more than 50% of another entity, then it's for determining whether you have a US shareholder, it's considered to own 100% of that other entity. And so if we just walk through this example, PRS1 owns 90% of PRS2, which owns 100% of the CFC. And if you didn't have to consider this constructive ownership rule, you would say, well, if I'm looking at A up at the very top, is A considered a U.S. shareholder or not? And you'd say, well, A owns 90% or 9%, 10% of PRS1, and indirectly, you would say, or constructively, owns 9% of PRS2, and indirectly or constructively owns 9% of CFC. And so since it's 9%, not 10, you would say it's not, A is not a US shareholder. Makes sense if you just follow and follow through and do the math. However, under this constructive ownership rule, PRS1 is considered to own 100% of PRS2. And so A, in that case, is considered a US shareholder because it owns 10% of 100%, or 10%, and therefore is considered a US shareholder and subject to GILTI. And so, again, main reason for including this slide is just to highlight the importance of constructive ownership rules, that if now, because of this final rule, we're kind of jumping over partnerships to determine whether a partner is considered US shareholder, we then also need to comply to the constructive ownership rules and say, okay, are there any other interests that partner needs to include when determining whether they're a US shareholder or not. Let's jump to the proposed regulations, and I want to highlight just a couple things. One, for 962 elections, that's for an individual trust or estate. They're typically eligible to make or to receive a 50% deduction on that GILTI income, and that's under the proposed rules for Code Section 250, and that's of course very favorable, and we'll see that as we walk through some of the modeling. Proposed Subpart F aggregation rule, that is proposed, and the reason it's proposed is Subpart F, or I guess under the proposed rules, what Treasury is considering is allowing for Subpart F purposes to treat partners the same as we just showed with GILTI. So kind of looking through the partnership and saying, well, do the partners themselves, are they considered US shareholders and thus subject to Subpart F income? That would be a departure from prior years of how the US has treated Subpart F income. That proposed regulation, although it's not finalized, there's a rule in there that allows a partnership to early adopt that going back to 2018. And then there's just some consistency requirements that related partnerships do the same. One of the more significant issues or considerations that came through on the proposed regulations is this last item on this slide, which is a high tax exception. So since GILTI came out, there's been concern that, well, if I have income in a foreign corporation and that income is being taxed already and subject to what we'd consider a high tax amount, then is GILTI really designed to require that type of income to be distributed back to the US? And we didn't get a lot of guidance. We got commentators back and forth saying, yes, it should, no, it shouldn't. Treasury guidance coming out, comments from Treasury conflicting at times. Over the past few months, maybe 6 months or so, there's been kind of a consensus that, yeah, if you have a foreign corporation that's paying something called a high tax, then that income should be exempt from GILTI. And that is in the proposed regulations. It's not in the final regulations, it's in proposed. And that also means that technically, I don't know if we can rely on it yet, and it's not effective yet. And so what that rule would say is if you have a foreign corporation and it's paying tax in the foreign jurisdiction attributable to our GILTI income, and if that tax exceeds 18.9%, which is 90% of our corporate tax rate of 21% right now, if it pays more than that 18.9% tax, then that income is considered high tax. And if it's high tax, then that means it's not required to be distributed or deemed distributed as part of GILTI. In other words, it's eligible for deferral. That would apply on a QBU by QBU basis. There's limitations on if you elect and then you decide you don't like that, and then you want to re-elect. There's a 60-month waiting period. One of the things that's fairly significant for US C corporations is that you really have to make that election for everybody in your controlled group. And so if you have a bunch of CFCs and you have some of them that have high tax income, and you have others that have low tax income, well, if you make this election, that means your high tax, the GILTI income that's in those CFCs with high tax is going to be eligible for deferral. That's not coming back and being subject to tax. But that also means that if you had interest in CFCs that had low tax income or no tax income, that income is going to come back as GILTI, and you may not have any foreign tax credits to offset the U.S. liability related to that low tax income, because you've kind of excluded the income of the GILTI that had high tax, and so when you excluded the income, you excluded the foreign taxes from your U.S. tax return. And that brings us to our third polling question, which says, does the final proposed 951A regulations affect your structure or 951A compliance? And the answers are yes, no, not applicable.
Hey, Aaron, this is Chris. Those are a couple of important points. I just wanted to just kind of stress the change that is happening here from how we have thought of the application of Subpart F and now GILTI to what would effectively minority shareholders, to the effect that even if you've already filed your tax returns this year and you are a partnership perhaps facing that situation, it would be worth paying attention to revisit this to ensure that if you had a GILTI or certainly a GILTI inclusion for the period, that it was handled properly for those minority shareholders.
Yeah, that's an important point. Thanks for mentioning that. I think I skipped over that bullet point, but with those final regulations, because they were issued before June 22nd, 2019, which was 18 months after the tax reform was changed, that means that those final rules apply retroactively or can apply retroactively, and they did. And so when we look at that partnership rule, being able to jump over it and look at the partners, if we've already filed our partnership tax return, then now technically we're required to go back and amend, and that may mean that some partners picked up GILTI income when technically they weren't required. So that could be a very favorable tax break for those shareholders or partners. Okay, and with that, let's go ahead and move on to structuring and planning considerations related to GILTI. And so to summarize where we're at so far, we've talked through the GILTI concepts in general, kind of how it works. We've also talked about these new proposed rules and this final rule related to partnerships and the impact that it could have on a US shareholder in GILTI. So what happens when we get to a point where we say, okay, we have a CFC, we have a US taxpayer that's considered a US shareholder, so they're subject to GILTI. What can we do to mitigate or avoid GILTI? And sometimes, I mean, if we're looking back at the 2018 tax return or tax year and we haven't filed that return yet, our options might be fairly limited. But if we're looking prospectively, then there may be some restructuring that we could do that allows us to get to a better tax answer. And typically, to get to a better tax answer, we look at amount of taxes paid in the foreign jurisdiction plus amount of taxes paid in the US, and that represents our global tax liability. And we say, is there anything we can do to lower that number by changing something? So a few items I would call in the toolbox for GILTI would be avoid or mitigate. They typically fall under one or two of those categories, or it's kind of a mix. Read off a few of them. We could restructure foreign operations. That would be, we could avoid a CFC classification. We could either do that by reducing the US shareholders' ownership to less than 50%. So now we don't have a controlled foreign corporation and the anti-deferral rules do not apply. Or if we had a foreign entity that was eligible for something called the check the box election, we could make that election and treat it as a partnership or a disregarded entity. And in that case, we would not have a CFC, but we would have a flow-through entity and GILTI would not apply. We could also insert a US C Corp holding company, and those are just a few of the ideas. And I'm going to walk through some numerical examples here over the next 15 minutes to illustrate some of those points. We could also structure into Subpart F. This was fairly strange to hear at first, but over the last year and a half, it's been something that's been talked about quite a bit. And that was because before we had this proposed rule with a high tax exception for GILTI, the thought was, well, if I wanted income to be exempt from GILTI, then one way that I could do that is I could make it Subpart F income, and if I could make it subpart F income and it was subject to high tax in the foreign jurisdiction, then that was exempt from subpart F deemed distribution back to the U.S., and that was also exempt from GILTI deemed distribution back to the U.S. And so typically a tax planner doesn't plan into subpart F income, but in this case, it was an idea that was floating out there for quite some time and still is a viable option for certain taxpayers in certain circumstances. The other ideas would be increased QBI, so that's our threshold, right? Our 10% of our business assets. Ensure CFCs with large amounts of QBI, make sure they have taxable income. One thing that I didn't mention is that we talked a little bit about when we have a US shareholder that has interest in several CFCs, they aggregate all that information to determine what their floor is and how much income they have and whether they have a net GILTI inclusion or not. Well, one of those rules says that in order to include your pro rata share of QBI in your calculation and aggregate it with all your other CFC information or GILTI information, the CFC that has that QBI needs to have tested income, positive taxable income. If you have a loss in that entity, then that QBI, that 10% threshold, or all those assets that are sitting in that CFC, you can't use those to be part of your 10% threshold. And so some taxpayers have found themselves with entities that have a really high or large amount of tangible depreciable assets, but they have a loss, and because they have a loss, they're unable to use those assets as part of their QBI calculation or their 10% floor. So making sure those entities have income then would free up those assets, that QBI, to flow back into their GILTI calculation and thus increase their floor. Reduce interest expense, use the GILTI high tax exception, which is just a reminder that's not quite available yet. And then individuals, trusts, and estates may utilize Code Section 962, which we'll talk through in a moment here. So those are kind of the tools in the toolbox. A few things to consider. Corporations are usually thinking about the dividends received deduction. So if they get through those two hoops, subpart F, GILTI, so they have income that's eligible for deferral, then they're typically eligible to get to the dividends received deduction. When a U.S. corporation, I should say, is eligible for that 50% deduction, and they have enough taxes paid in a foreign jurisdiction to completely offset their U.S. tax liability related to their GILTI inclusion, then that C Corp may want to push more income into that foreign corporation because, as I mentioned earlier, when they pick it up as GILTI, they get a 50% deduction. They don't get that if they're just selling products to other domestic customers, or they're selling those products directly from the US entity. And so by shifting income into GILTI and then picking it up that way, they get this statutory 50% deduction. Individuals, a few of the considerations for them, typically they don't get the 50% deduction or to claim foreign tax credits for income taxes paid at the CFC level. If they make a 962 election, they are eligible for those. And we'll walk through why somebody might want to make a 962 election and why they wouldn't. And with that, let's look at a few comparisons between different types of shareholders and different structures. And so we'll start here with a corporation versus an individual. So what would be the difference if we had a US C corporation owning a CFC versus just a US individual owning a CFC? And here we have a numerical example. I'll outline the flow of this diagram because it applies to the remaining slides. And that's at the top, on the rows at the top, that's our foreign jurisdiction income, and that's our foreign taxes paid there. And then as we flow down, we have our US corporation tax and our corporate deduction. And then as we get towards the bottom, we get to our individual tax. In this case, if we're just comparing, what would be the difference if we had a C corporation owning the CFC versus an individual? Looking on the left-hand column, we'd be pulling in $1 million of income. That would be our 800,000 plus our foreign tax credit gross up of 200,000, so we get to $1 million. We get a 50% deduction, so we'd only have $500,000 worth of income to subject to tax. We'd multiply that times 21%, and that would give us to 105. But recall, a C corporation is able to claim foreign tax credits against that income, and so the tax credits in this case would be 80% of the 200 that's listed above, and that would give it a $160,000 tax liability, or a foreign tax credit, which completely eliminates the 105 tax liability in this case. And as we flow down, still in the left-hand column, then the U.S. individual would pick up an $800,000 dividend, multiply it times qualified dividend rates, and arrive at a final tax liability. And at the end of the day, under the C Corp option, we have around 39% of an ETR. Notice if we hop over to the right and we go to the individual, that individual is required to pick up the 800 of GILTI income at ordinary tax rates. And if you throw in net investment tax on it, that can be quite a substantial tax liability. And in this case, the difference at the bottom for the ETR is around 53% compared to 39%. And so you can see if this was the only option for an individual, things would be pretty grim for them, because if they had inserted a USC corporation into their structure, they would get a much better rate. But in this case, if they hadn't done that, and absent a 962 election, which we'll see coming up, they would be stuck with the 52%. Let's look at a corporation. So one of the key planning ideas for corporation is to be able to get through that subpart F hoop, get past that GILTI hoop, and get to income that's deferrable, right? And if it's deferrable, then it's typically eligible for the dividends received deduction under Code Section 245A. And this slide just illustrates the difference between the two. I've changed the math a little bit in that I've changed the foreign tax from 200 to 100. So that's the difference from the prior example. And you can see on the left with GILTI income, when you get down to the ETR, we're down to around 33%. Whereas on the right, if we could use no GILTI and then claim 100% dividends received deduction, we'd get down to around a 31%, 31.5%. Really the difference here is towards the middle row, where the corporation has that $1 million of income that it's including, but again, it gets a 50% deduction for GILTI income, so it's down to $500,000 of income. Multiply that times the 21%, and in this case, recall that we're only allowed to use 80% of our tax credits that are attributable to GILTI. So that only gives us an $800,000 or an $80,000 credit, and we have a residual tax liability of $25,000. Note, in comparing these two, if in the foreign jurisdiction we had more tax paid, like let's say $200,000 of tax, then our tax liability is going to be the same under either scenario, because at the US C corporate level, with GILTI, our foreign taxes paid in the foreign jurisdiction would completely offset our US tax liability, compared to with the DRD deduction, where we're not paying any tax on that income because we receive 100% dividends received deduction. And so foreign taxes in the foreign jurisdiction definitely matter, and can either make this a decision point, or it could make it so it's just indifferent. So how about individuals? Individuals, this is a slide that shows a few examples or options for an individual. And if there was no GILTI, really for modeling for an individual, the answer would be, it depends. Do you want an individual to own a CFC directly or not? And you'd say, well, I'll look at the foreign taxes paid in the foreign jurisdiction. And you can see in all three examples, they're a little bit different, and that significantly changes the ETR at the end of the day. And the one where we're paying very little tax in a foreign jurisdiction, all the way on the right-hand side, creates the best option. And note here that I'm assuming that in each option, the foreign entity, the CFC, is located in a treaty jurisdiction. Why does that matter? It matters because on a dividend from an entity from a CFC in a treaty jurisdiction, typically that dividend is eligible for qualified dividend rates. And so if these entities were located in non-treaty jurisdictions, then that US tax rate attributable or assessed on that income would be ordinary rather than qualified. We'll quickly jump through an individual again, looking at GILTI, but instead of C Corp versus individual, we'll look at it from an individual owning directly a CFC and treating that CFC as a corporation, or that individual, perhaps on the right-hand side, could make a check-the-box election to treat that foreign entity as a flow-through for US tax purposes only. or if the individual were able to eliminate the entity altogether and just have that activity in a foreign jurisdiction using a branch concept, the answer would be the same. And in this case, again, without or in absence of a 962 election, on the left-hand side, they don't fare too well. They pick up all the GILTI income at ordinary tax rates, and it's subject to around a 53% tax. On the right-hand side, though, if it's flow-through, what that does is it allows the U.S. individual to use income taxes paid in the foreign jurisdiction as a credit against U.S. taxes, because the U.S. considers that, well, if it's flow-through, then that means that the individual, you can think of it as, is deemed to pay those taxes directly. And so the individual still picks up, in this case, they pick up all 1 million of the income, and then they use a 37% rate, which is the assumption here, but they get the $240,000 of tax credits to offset their U.S. tax liability. And that's really the key. That's what's helping them in this example to get down to a 37% rate. Notice on the right, I have assumed that net investment tax would not apply. It could apply. And if it did, that would, of course, increase the tax liability and our ETR. But in this case, the difference is still fairly significant. And that brings us to polling question number 4, which is, have you modeled out the tax implications of Code Section 951A to confirm whether existing structures still produce the best tax answer? Yes, no, not applicable. We've tried to keep the answers as simple as possible.
Hey, Aaron, this is Chris again. Just wanted to remind everybody, if you have any questions, you could try and post them here, but I know we are short on time. Fear not, if you do have questions and they come up as time goes on, feel free to reach out to either Aaron and I. We'd be happy to discuss them with you outside of the scope of this conversation today as well.
All right, so it looks like a few have already done it, already looked at whether this, how GILTI applies to their structure, but maybe some work to do for some others. We're nearing the end of the presentation. I have a few slides left, and we're going to fly, maybe not quite at the speed of light, but we're going to move fairly quickly through a couple of these slides. And I want to touch on the 962 election. First, just touch on the requirements. One, you have to, for an individual to be able to make this election, they need to be a U.S. shareholder. And this election, what it does, as we've seen through the illustrations on the prior slides, we've seen that an individual generally does not get the 50% deduction, generally does not, is ineligible to claim foreign taxes for income taxes paid in the foreign jurisdiction. So they don't get a credit for the income taxes paid in the foreign jurisdiction, and they don't get that 50% deduction. However, under Code Section 962, an individual can make an election on their individual tax return, and they can elect to treat themselves as a corporation related to GILTI income. And what that allows them to do is it allows them to take the 50% deduction and allows them to claim foreign taxes against that, the U.S. tax associated with that, with GILTI income. So what would be the effects of an individual making that election? Well, if they didn't make the election, they pick up the GILTI income, it's ordinary income, but then they get basis, right? And they get a PTI account. So later on when they receive the distribution, it's not subject to tax again. On the other hand, if they make the 962 election, now they're introducing 2 layers of tax. So that first layer is they treat themselves as a corporation for GILTI income. They calculate the 50% deduction, and perhaps when they use the foreign taxes paid in the foreign jurisdiction as a credit against that corporate tax, then they may end up with a 0 tax liability, which is, of course, very beneficial. But the downside is that when there's an actual cash distribution from that foreign corporation, the individual picks that up as a dividend. And if that foreign entity is located in a treaty jurisdiction, again, they may be eligible to claim that as a qualified dividend. And let's look at just a couple examples. This would be GILTI with 962 versus no 962. And you can see in this case on the left, with the GILTI or with the 962 election, their ETR at the end of the day at the bottom there is 39%. That's the same as if we had a C corporation in the holding structure. And of course, without the election on the right-hand side, we're still at that 53%, which we've seen in prior slides. So making the 962 election can be very favorable, as shown here. One of the variables, again, I just want to repeat it because it's worth mentioning. The tax rate that the individual is paying on GILTI income on the left-hand side is the 23.8%. And so that assumes that that foreign entity is located in a treaty jurisdiction and they're eligible for that qualified dividend rate. But if that entity was located in a non-treaty jurisdiction, then typically that's going to jump up to ordinary rates, and therefore the 962 election might not be that favorable. So we're finding that maybe individual taxpayers that have investments in CFCs, and those CFCs are not located in treaty jurisdictions, 962 may not be enough. It may not really help them out that much. And so restructuring to maybe that flow-through model that we saw on a previous slide may be a better option, or inserting the US C corporation in the structure may give them a better option, as shown here, which is inserting a US holding company into the structure. And although we add in a second layer of tax, recall that that US C corporation would be eligible for the 50% deduction and eligible to claim foreign tax credits against that GILTI income. And so if we eliminate the income tax at the state level, or at the federal level, then maybe we're better off inserting the US holding company. One item I want to mention that can really affect modeling related to GILTI is kind of the unknown sometimes, which is state tax treatment. And so if states harshly tax GILTI or have a different manner of taxing GILTI, then that may impact the model. And if, of course, we're close on various options and we're only maybe a percentage point or half a percentage point, it definitely is worth looking through all the way to the states, both for the individuals and for the a US C Corp in the holding structure or in the ownership structure, to determine whether that's going to negatively affect our GILTI calculation. And with that, I think I'll turn it over to Amy to talk about July Business Trends webinars.
All right. So as you can see on the screen, we do have some more upcoming webinars for the month of July. If you would like to attend any of our webinars, please just visit our website and you can register for as many as you would like. And with that, Aaron or Chris, did we have any ending comments? I don't see any questions in, so.
Okay, well with that, none for me. Just really want to appreciate everyone's attendance. It was a pleasure to present on GILTI, and of course, if there are any questions that have come up or that come up later on, as Chris mentioned, feel free to reach out to either Chris and I. We're happy to discuss those, brainstorm, etc.
Awesome, thank you guys, and everyone have a great day.
Take care, everyone.